The global economy is still suffering. It's easy to tell. Just look at how much stimulus these fools need to project in order to keep it barely alive. But it's the best economy ever, we are told. I tend to disagree. The stock market frenzy can continue for a while, there's no doubt. It can break beyond any barrier we have ever thought possible. But in the end, people have stretched themselves too thin and will be punished for ignoring risk. You came here for the truth, so let me unveil that for you. Today I want to get into something that's very important, and that is the individual. Where are they at today, and why is this the case? In this instance, we are going to talk about 53% of Americans living paycheck to paycheck, but I want to mention something first. Today we watch the stock market achieving all-time record highs. That's excellent. That's fantastic. And often you see a critical element on this channel here talking about how I am somehow guiding people away from this, and it's my fault why individuals have not made more money. Well then, let's cover that first. If you remember, I did this video. It's a 60-second video, how the global economic collapse will happen. And essentially, in the video, for those who watched it, I basically suggest however the central banks decide, that's how it will go. If they print money, stocks can go higher. If they take that away, stocks will go lower. I break it down, I document it, I showed you in 60 seconds. But the majority of those who are critical never watched it, and they're not watching this and they're not listening to this at this point. Then I had this one. Sell all your stocks and buy these 4. Now I did the video a little bit tongue-in-cheek, but essentially what I was suggesting was look at what the central banks are buying and buy the same thing, and then you will do well simply because they're willing to print to infinity. But did they watch this video? Of course not. Well, this basically explains my entire thesis, and that is we need to watch what the central banks are doing and the stock market will go accordingly. That's it. That's all I wanted to get across from basically all of my videos, but there is this element that's there suggesting I am guiding people away from it. All I'm doing is providing an alternate source of information. If you just watch the Money GPS, you're only going to get my viewpoint of this. You have to look into the data yourself. Of course, if you're an astute person, you're going to be reading every single day. You may watch the Money GPS, but you're also going to be reading books every day. You're also going to be watching other individuals. You're also going to be looking to the documentation yourself. You're not just going to watch this and form your opinion from one video. If somebody sees a video and somebody says, this is the stock I'm buying today, therefore I'm going to buy it, that is crazy. How people are investing today is nothing but speculation. It's nothing but gambling. Why are you betting all your chips on black? You don't even know. This is a gamble. This is a risk. And that's not what we do here. So look at this one. Here you're seeing the green line, which is basically the S&P 500 rocketing higher. I mean, it's been going in this direction for months since basically the last week of 2018. Happens to coincide entirely with the global money supply. That's right. This just shows you that they have been completely correlated. It was also correlated in 2018, which was quite interesting. We saw the central banks around the world decreasing their monetary supply, and as a result, stocks began to fall. It did this quite considerably throughout this period. And then as soon as the time came for the central banks to print up more money, for the Federal Reserve to say, okay, we're going to stop our tightening cycle, this sent the markets higher. But I want to mention something about the Federal Reserve and raising interest rates at the end of this video. So stay tuned for a minute. I'm just going to go through a few of these. Hours worked to buy the Dow. Okay, this is a calculation that you'll see someone like Michael Maloney doing frequently in his books. He talks about this, and you basically, instead of buying the Dow in dollar terms, you can do so in gold, in wheat, in hours of work. You can do it in all kinds of things to give you an idea of one thing versus another instead of always measuring it in the dollar. And here you're looking at it being the absolute highest it has ever been right now in the recent past. This tells you how ridiculous the prices prices are in comparison to the average salary. It's the same thing with real estate. Oh well, real estate's going to keep going higher because people keep moving to this country and buying up the houses. Do you really think that that's sustainable in the long term? Of course not. You can't do that because the prices have gone too far, too fast, and the average person can't keep up. You got a big problem on your hands when that occurs. This happens to be the global monetary supply in the inverse, as well as the VIX index. And take a look at this correlation. It's perfect. Obviously, the more money they print, the more you're going to see that VIX drop. It's very clear. Up on top of that, you also have the Federal Reserve, and they've been working their magic left, right, and center. It's pretty funny actually to see what the Fed can do. They literally admitted to having a short policy on the VIX. Nobody even cares. They really don't. Speaking of the VIX, look at this. You're seeing the rate at which they are shorting the VIX today is at the level we haven't seen, basically the same level as it was just prior to the whole VIX disaster that happened in January of 2018. That's where we're at today. It's such an easy trade to short the VIX, to think that the VIX is going to go down as it's ever been before. We've never been at these levels. This is disastrous. And you know when it was just a little bit better than where it is today? Well, see for yourself right here in 2018, right around that time when everything was looking rosy, stock market was rocketing higher around that September, maybe October time frame, and then things changed. We've seen this same activity occurring twice in a row. This happened in 2018 after being so obvious that this was the best trade from 2016 into 2017. It reversed in an instant. People lost their shirts as a result, and then we saw the turmoil throughout 2018. They had to change the rhetoric towards the end of 2018, right at the end there, and then we see the same thing happening today. The rate at which it went from the point of this peak up here that you're seeing basically at the end of 2018 up to where we are today is, I believe, the fastest it has ever turned around. So as long as the central banks are willing to print, then investors are willing to dive in head first. Look at this, the VIX 17-week rate of change. It has never been this way since all the way back. It's going to 1990. I don't know how far the chart goes back specifically, but it is literally has never been this aggressive in the rate of change ever in history before, at least since they've been calculating it. So all of that madness just to get to what I really wanted to get into. So if you're still here, thank you. 74% of Americans put 10% or less of their monthly paycheck towards savings. Imagine this here, that the individual doesn't save money. In fact, 23% report they put 0% of their monthly paycheck towards savings. 49% report they only have enough liquid funds to cover living expenses for 0 to 3 months. And I speculate that it's probably more towards that 0. And 26% attribute high cost of living as to why they don't have as much as savings as they would like. Now, this really highlights the point that I have. Individuals today, they're broke. They're in debt. They're so far down the ladder that they don't understand what's happening at the very top. This has really caused the problem that the average individual does not understand. The average person, they go to their 9-to-5 job, they pay their bills, they do what they can, and they struggle all the way through. We are seeing right now a division in between the rich and the poor, at which we haven't seen since the roaring 20s. If you look at the stats, if you look at the quotes, if you read the books that were written at that time, during this time frame leading up to 1929, it was the best time ever in history. People were laughing, they were singing, they were doing so well. And you didn't hear about all those individuals that were not doing so well. Things changed in an instant. Suddenly, this started to become an issue when you saw a great divide. I do believe that we are seeing elements of this today. That information comes from this right here, First National Bank of Omaha. It's only a sample survey, okay? When we get these, there are 1,000 people, sometimes there are 10,000 people. All I wanted to show you is that this happens to correlate entirely with all of the other surveys I've showed you. It's different people being surveyed, and yet we are tending to see basically the same data appearing over and over again. So I can't confirm what the average is over the entire United States. But in all these surveys, we tend to see something like this every single time. 53% are currently living paycheck to paycheck. Everything for these people who live paycheck to paycheck is fine. Absolutely. You can do that. You just go about your day, you buy your Starbucks, you get to work, you take the train, you drive the car, you fill your gas, you buy your food, you go see the movies, you buy this, you buy that. Everything is fine. You lose your job, everything breaks down. Something else in the way, an obstacle of some sort, medical expense or what have you, suddenly everything breaks down. It's only when everything is perfect that you can successfully live paycheck to paycheck, as apparently half of the people do today. And unfortunately for so many people, there are six-figure individuals that are in this position. It doesn't mean that, they're making 20 grand, they can't make ends meet. No, we're talking about everybody is in this state today. There are so many people. Every time I do videos about this, you look in the comments and you will see people talking about individuals that they know, they're making six figures, and yet unfortunately they're so far in debt they don't know what happened. We cannot get ourselves into this position because it's very difficult to dig ourselves out. America's elderly are twice as likely to work now than in 1985. I hear it every time and I gotta mention it every time. Look, if you want to work for the foreseeable future, that is great, that's excellent. I think people should work whatever job they want, something that they are interested in, something that they're passionate about, or something that just entertains them throughout the day. However, many people do not want to do so, and they are forced to come out of retirement, or they simply have to work as long as they possibly can. But then you have a health issue, you have a family member you need to take care of full time. Things happen over time, and unfortunately a lot of people are screwed over by this one very thing. Just as single income families began to vanish in the last century, many Americans that are elderly are now foregoing retirement for the same reason. They don't have enough money. For the first time in 57 years, the participation rate in the labor force of retirement age workers has cracked the 20% mark. It was at 10% back in 1985. And if you look at the participation rate, obviously over the years it had come down significantly, but now more recently you have seen it tick up like this. And this could be a contributing factor to that. We're down significantly from the peak, obviously, but you've seen this come up, and I do believe that this is playing a role in that individuals, they're poor, they're broke, they're in debt, they can't make ends meet. And what are they doing here? You're finding them coming out of retirement or simply working longer and longer. And unfortunately for them, they want to be retired, they don't want to work, but something is forcing them to be in that position. And it is truly unfortunate to see it happening to so many people. I hear from people every day on this issue. Now, you're not the only one that's in debt, I assure you. Just look at this. You could see actually the IIF has a little bit of humor, the Institute of International Finance. Only, they put it in quotes, $3.3 trillion was added to the global debt mountain last year, bringing the total to over $243 trillion globally. I mean, come on. The funny part about this is that it's using the manipulated stats, not even all the real things added up on top of that. We are just talking about the official government numbers, and we are at 243 trillion. This is far beyond what we've seen with the GDP, which is already terrible as it is. It's so manipulated. And that, look at this, 243. My goodness, we are in a serious bit of trouble. Now, if you still are here, you made it to the end, thank you. Take a look at this information from the Federal Reserve's data. We are looking right now at the Fed funds rate at 2.44%. That's just 6 basis points from the top of the target range. And unfortunately for a lot of people, they didn't see what happened last time, the time before that. Look at the Fed funds rate. You understand that it's obviously a range, 2.25 to 2.5 here at this time. But what we tend to notice is that it actually, so if you look at it, you see these steps basically. It goes up a little bit, obviously within this range. But if you look at it a little bit more closely, you will actually see that there's these steps up on the way up. So we are noticing this, and you won't see it unless you look at the actual Fed funds data from the Fed website, but there are little steps on the way. Now, once it gets to that end, let's see if I can put this here. Once we get to the end of that, we tend to see them increasing interest rates. So once it makes it to the top end of that range, they will then at some point in the near future increase interest rates. That's what they've been doing this whole time since the end of 2015 as they've been increasing rates. Here you're witnessing that, and I just found it interesting to see that we are actually still moving up. So I remember just a little while ago it was at 2.4%. So it was sitting for a little while at 2.4, and now it has made its way to 2.44. So if it gets to 2.5, are they actually going to increase? Are we going to see an increase in the Fed funds rate? This is what a lot of people, this is why I started with that point in the video, and now I'm bringing it at the end, bringing it full circle. There's a method to my madness. We are watching the stock market go to new highs, right? So let's say we see the Dow Jones at record highs. We're seeing the S&P clearing 3,000, clearing 3,100. What do you think is going to be the response from the Federal Reserve? They told us everything in the economy was looking strong, that it was looking good, but we're going to hold off on interest rate increases for now. How silly would they look if they don't increase interest rates when everything is supposedly just fine? That's up to them. I'm going to cover it here on this channel. If you found this informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel, so I do appreciate that very much. If you want the financial education you weren't taught in school, these two books have everything you need from top to bottom, A to Z. Check them out at the link in the description. If you want the audiobook, that's available at themoneygps.com. If you want to see that video, it's 60 seconds long. It breaks down exactly what's going to happen with the stock market based on what's occurring with the central banks. Click on this video and I will see you there.